Welcome to Keen Mortgages, Mortgage Basics for Real Estate Agents, Realtors, or Brokers. This is the first one we're doing, and definitely looking forward to keeping this going. So the next one will be on the first Tuesday of next month. I'm not sure what date that is yet, but it's in March. So anyway, we're going to have Kelly Stasny hold this class and do the instruction on it, and I will turn over to her now.
Hey there, everybody. Thanks for joining us this morning for an illuminating discussion about mortgage insurance. I know it's not always the most exciting topic, but I figure the reason that most of you are here is because either you're a new agent or you're an agent who wants to sharpen up some of your skills. And really, there are two reasons why information like this is important. One, obviously, you want to be an expert in your field. It may not be your job to originate a loan, but you're the first person that a client generally speaks to, and you want to be able to answer their most basic questions. That makes you a valuable resource and somebody that your client will continue to call. Number two on that point is retention. Because you're the first person that your client is likely going to speak to about the home buying process, you want to answer as many of their questions the first time around, the first time you speak with them, either on the phone or the first meeting you have with them. The more you have to send them elsewhere, the more your client retention goes down. So the first time that you speak with them, you want to be able to speak intelligently, to answer any of those basic questions that they have. And mortgage insurance does come up in those conversations. So why do you need to know about mortgage insurance in particular? So here's what's going to happen. You're going to talk to a new client. Either it's somebody who's done this before, or it's somebody who is a first-time home buyer and they are green in the process. What's the most important question that they're asking? How much can I afford? What is this going to cost me? If you have a borrower with less than a 20% down payment, which is a lot of borrowers, it will affect their monthly payment. And so we want to teach you just a sort of broad strokes about how to calculate how much their mortgage insurance is going to be monthly. And that's going to be able to help you answer that question. What's my monthly payment going to be on this? So what is mortgage insurance? Mortgage insurance is referred to as MIP, MI, PMI. All of those things, while they have a slightly different technical meaning, they all to you mean the same thing. Mortgage insurance. It is a policy of insurance that a lender will require your borrower to pay for if their down payment is less than 20 to 22% when they buy their house. Unlike a couple of other insurance policies that your borrower ends up having to take out during the purchase process, mortgage insurance benefits the lender. It's paid for by the borrower, but it benefits the lender in the event that your client defaults on their mortgage. Why does it exist? So back in the mid-1900s, when a borrower wanted to get a loan, they would go down to their local bank or their local savings and loan, and that banker would require at least 20 to 30% down in order to issue a mortgage or to get a loan on a house, in addition to charging 20 to 30% in interest. So in order for banks to feel comfortable lending with smaller down payments, mortgage insurance was created to help banks limit their losses in the event that your borrower doesn't make payments on their loan. So ultimately, while nobody wants to pay for this mortgage insurance, it's a benefit to your borrowers who don't have a 20% down payment. It has made our mortgage landscape way more robust. There are so many more mortgages that are available to folks who have a smaller down payment because mortgage insurance exists. How does it work? If you default on a mortgage loan, if a borrower defaults, a bank will initiate proceedings to foreclose on that property. That's the legal process by which a bank will gain ownership of the actual property in an effort to recoup some of the money that they lent to the borrower that wasn't repaid. After a foreclosure is complete and a bank owns a property that they had a mortgage on that defaulted, the bank will sell that property in an effort to get back the money that they lent to your borrower. If there's a shortfall, so if after they've sold that property, the bank still has some losses, maybe they lent more than they were able to sell it for, or maybe the borrower didn't make payments for a long period of time and there were additional interest and penalties that were incurred on that loan that are losses to the bank, mortgage insurance will help to pay for those additional losses. So mortgage insurance doesn't pay for the whole value of the property. It pays for losses that the lender has after they've foreclosed on a property and after they've sold that property and recouped a majority of the money that they've lent. How do you get it? When a borrower submits their loan package to us as the lender, we apply for the mortgage insurance on their behalf. So your borrower will not be responsible for applying for mortgage insurance the same way that they are responsible for applying for homeowners insurance. It is taken care of by the lender. So that will happen behind the scenes. There's nothing that you need to do as their broker. There's nothing that the borrower needs to do in order to make that happen. The lender will require it and they will do the paperwork for that insurance policy. As the lender, we know upfront what that mortgage insurance premium will be, and we disclose that to a borrower on the initial loan estimate, which is due within 3 days of loan application. So your borrower knows upfront exactly how much that's going to be, and we're going to give you some estimates as to what that is so that you can estimate that when you're in your mind thinking about how much their payment is going to be. Mortgage insurance is paid in 2 ways. There is upfront mortgage insurance that is a lump sum that's due at the closing. That's upfront mortgage insurance premium. There is also monthly mortgage insurance, and that mortgage insurance is a small amount that's paid every single month with your mortgage payment. An upfront mortgage insurance policy is a lump sum, like we said, it's paid at closing, and that is only applicable if your borrower is getting an FHA loan. If your borrower is obtaining a conventional loan, they will only have monthly mortgage insurance. Upfront mortgage insurance, let's talk about FHA mortgage insurance. FHA mortgage insurance requires both an upfront payment and monthly payments. The upfront monthly payment is 1.75% of the loan amount. The monthly payment is going to be in between 0.45% of the loan amount, so a fraction of a percent, up to 1%. And it varies based on the LTV, or the loan to value, how much money they're putting down, and also the borrower's credit score. The bigger the down payment and the higher the credit score, the lower the mortgage insurance. Okay, so for an FHA loan, like we said, the upfront mortgage insurance payment is 1.75% of the loan, and it's paid at closing. As a side note, it can be wrapped into the mortgage. The borrower doesn't have to pay that out of pocket. The monthly mortgage insurance will be paid with their monthly payment, and it's between 0.45 and 1% of the loan amount. On a conventional loan, there is no upfront mortgage insurance premium that needs to be paid at closing. The only mortgage insurance a borrower will pay on a conventional loan is monthly. And those insurance rates vary from 0.15%, very small, to about 1.2%. And obviously there's a big variance there. And that's mostly due to a borrower's credit score. So I'm going to give you a couple of calculations here, and that will give you a general idea of what those mortgage insurance payments are going to be. So we'll start with an FHA loan. FHA, great for borrowers who have maybe some credit building that they need to do, or past credit events, bankruptcies, things like that. FHA loans are fantastic for those. They do require, as we said, 2 types of mortgage insurance. So for an FHA borrower in the Denver metro area, let's say a first-time home buyer is buying a property for $400,000. Let's say the minimum down payment that they can bring in on an FHA loan is 3.5%, and that's what they're going to elect in this scenario. So their down payment is $14,000, leaving them with a loan amount of $386,000. At the closing, they'll be required to pay an upfront mortgage insurance premium of 1.75% of the loan, which is $6,755. That's a chunk of money, especially for somebody who's trying to limit their down payment. This can be wrapped into their loan, just so you know they don't always have to come out of pocket with that money. Every single month, when they subsequently make their mortgage payments, they're also going to be making mortgage insurance payments of, in this scenario, 0.85%. With a 3.5% down payment and average credit, your mortgage insurance rate is going to be 0.85% a month. That's $273.42 a month worth of mortgage insurance. That's what's going to be important for you to know. As you are telling your borrowers what their monthly payment should be, you can use a mortgage calculator on your phone, and that's really the simplest way to do it. You're going to want to type in that they are going to have 0.85% in mortgage insurance, and that will add this monthly cost to their overall mortgage insurance payment. Alternatively, if your borrower is getting a conventional loan with the same purchase price, $400,000, let's say this borrower is putting down 10%. They've got a loan amount of $360,000. Their upfront mortgage insurance that due at closing is $0. There's no upfront mortgage insurance on a conventional loan. And their monthly mortgage insurance is going to be based on how much of a down payment they put down, as well as their credit score. In general, conventional loans are going to be for borrowers with higher credit scores. The higher your credit score, the less you're going to pay for your money. In this case, the mortgage insurance is 0.35%, which is about $105 a month. The way to calculate, if you're going to manually calculate your mortgage insurance, this is that calculation. You're going to take the loan amount times the mortgage insurance rate. In this case, it's 0.0085, 0.0035 down here, divided by 12. And that's going to give you your monthly mortgage insurance premium. So if you guys have any questions about how to calculate mortgage insurance, if you'd like to go more in depth about why it exists, who offers it, how much it's going to cost your borrower, if you'd like to go in more depth about how to calculate that, how to quickly calculate that in your mind, or any good mortgage calculators, if you want some suggestions for good mortgage calculators, feel free to reach out to us. Kelly at keenmortgage.com, or my direct phone number is 303-591-5733. Thanks so much for joining us today.
And also check out www.keenmortgage.com. And we'll see you on the next Tuesday of the first Tuesday of this coming March on the next topic, which we still have to determine. So thank you very much.